So I'll be using this review to actually help my own self do a review of this book, The Intelligent Investor by Benjamin Graham. And to start off, I have actually read from the first page to 19th page, but for the time being, I'm only going to discuss and analyze for my own self, not for anyone else. The page 1 to 11, that is like the introduction page. And the introduction is what this book expects to achieve. And it's an important question that what is this book all about? It's not about how to actually analyze the securities. It's not about how to make value. It's rather about how the investor's perception is all about and how things go like that. Investor behavior is a really important thing, which Benjamin Graham really emphasized that most of the losses that people or fund managers or investors are making, it is not because of anyone else, but it is because of their own self. And to keep that in mind, it's really important to understand what we are losing here and what we are not, because it's only upon our own psychological behavior that we tend to make is what determines that are we going to make a loss or are we going to make a profit out of our investments. And investor behavior is a really important thing, which was covered in the first 2 pages. So all was investor behavior. Then there was past examples like people who have invested a lot in areas which they thought were right, but they failed pretty bad because of the reason they weren't relying on a particular set pattern that they had to go follow. And they actually some of them actually criticized Benjamin Graham for being not a speculator and to have all these sets of rules developed for investors. He should have not developed those rules because they cheated all those rules. And some of them actually made 250% return in a really brief amount of time, like almost like 5 months, if I recall correctly. Um, yeah, some of them actually made such huge profits out of companies like um, airline businesses from technological business stocks, and IT stocks were particularly higher in the 1980s area and in the New York Stock Exchange, of course. And they earned a lot there. They earned a lot there. But soon after, they thought that they have defied the laws of investing, which Benjamin Graham is discussing here. They soon realized that they make a loss. They make a loss in the coming years in those same stocks, because Benjamin Graham discusses about the fact that even if a company is really good and even if an industry is really promising, you cannot base that on what the investors are going to pay for it, because if everyone is thinking that a company is good, its price is already higher and it's not low. And if a stock is already higher, then the underlying value is probably lower because everyone knows that a company is going up. So he argues that that company is more valuable and that company is more awesome, which not many people know about, which is a new fish, which you realize is a good company, but not many people. Because if everyone knows it's a good company, the underlying market value would be lower than what the price is offered, because the stock markets are taking the effect from what the investors are thinking. Another important point was, now this book was written in 1949, and the revised version is in 1972. So much has changed from that that date. For example, one of the major things was interest rate. Interest rate on high quality bonds went from really low, like from 4.4% in 1949 to some 7.12% in 1972. And that's quite significant because we are comparing these two markets, the high quality bonds and the high quality stocks, like the common stocks. And you discuss both of these things.